Hello everyone, this is Jitendra Gohil. I am the Chief Investment Strategist at Kotak Alternate Asset Managers. Today we are going to discuss about India's growth trajectory. India is not only the fastest growing economy, but also one of the most resilient in the world. I am going to highlight 4 parameters on which we are going to evaluate India's growth trajectory as well as the resilience. First being the fiscal deficit. In 2021, during the COVID period, our fiscal deficit went up all the way to 9.2% of GDP. And today, in FY25, we are expecting it to contract to almost 4.9% of GDP. Despite faster consolidation in fiscal deficit, we have seen significant expansion in India's GDP growth. Second, current account deficit. India's current account deficit is expected to be around 1% of GDP, and that is because of 2 parameters. One is service exports. India's service exports could double to around $800 billion by 2030. This, coupled with inflows from remittances, will benefit India's current account deficit. Third, inflation data. Despite faster economic growth, our inflation has remained well anchored, and this gives RBI further headroom to ease monetary policies. Inflation today is below 4%, and this despite geopolitical tensions, supply chain disruptions in the past. And what we feel is that because China's GDP has been slowing down, we think that the commodity prices will remain well anchored, including oil. And hence we think that India's inflation trajectory will remain largely supported. Fourth, the resilience of INR. So faster fiscal consolidation, better management of inflation and current account deficit. It is clearly reflected in the resilience of the rupee. Despite the difference in interest rates between India and US has been one of the lowest in the history, around 100 basis points, the volatility of INR has been one of the lowest in the history. And this is clearly reflected in forward cover, which is currently at around 1.8%. Certainly the geopolitical issues are cause of worries. However, today RBI's reserves are around $671 billion, and this gives RBI better headroom to manage volatility in the INR due to any external forces. In conclusion, this improvement in financial parameters put India in a bright spot. Hence, we recommend to stay invested in equity market. However, given stretched valuation, we recommend to cut beta of the portfolio by investing in defensives such as pharma, consumer-focused companies and select financials.